we've seen the world changing quite considerably over the past 1 decade, especially since the 2008 global financial crisis. So we are in an era where central banks across the world are just cutting interest rates. Prior to the global financial crisis, there was an existence of correlationship between various asset classes, namely stocks, bonds, and commodities.
Sure.
But since 2008 financial crisis, traditional relationships between these asset classes have changed. For instance, if you look at the business model, when it's in contraction, you see bonds bottoming out first, then
Sure.
stocks, and then commodities.
Sure.
And as the economy moves into expansion, you see bonds topping out first, then stocks, and then commodities. But since the past 10 odd years, we have seen stocks and bonds being in a very perennial bull trend because of ultra accommodative monetary policies.
Correct.
Liquidity is being pumped across the world, because of which money is just going into bonds and equities. On the other hand, commodities, despite so much of stimulus, is underperforming significantly. So that correlation between stocks and commodities has kind of broken. So my question to you is, going forward, do you see this kind of correlation, this traditional correlationships that has existed for the past several decades, changing because of the actions that are taking place around the world?
I absolutely think so. I think the evidence out there is very clear. There have been correlations that have held very strongly through all kinds of cycles. Dollar crude is a good example. Dollar gold is a good example. And I can only say central bankers have disrupted the traditional mechanics of the asset allocation process, which explains why correlations are no longer as important as they used to be.
Exactly.
But one of the other things about correlations, if you look at history, is correlations tend to be very fleeting. There have been periods when correlations were very strong and were also logically explainable. And then without any warning, those correlations simply broke down for a certain duration and then, caught up again. But, and I was making, this point earlier in the day with someone that I was speaking with. 2008, 2009 was an era where there was so much household debt, people were leveraging themselves twice over and thrice over to buy additional properties because the value of the home just kept going up. And then 2008, 2009 happened and people realized so much debt is not a good sign. Fast forward 10 years and that debt has been transferred from households to governments. And central bank balance sheets have gone through the roof. So if 2008, 2009 was the result of too much debt, and we all saw the kind of pain that every asset class kind of went through, imagine if that debt were 100 times bigger, which is the situation that we find ourselves in today. And clearly the accommodative policies of the Fed and other central banks that have followed suit have kind of created that moral hazard problem where you expand your balance sheet to an extent where if you go under, it'll pose a risk to the entire financial system. I think the big risk for the markets now is people saying, central bankers have our backs and we can just buy anything that's going up and we don't have to look at rational behavior anymore. Just keep buying it, because if we end up holding too much of that security and we become too big to fail, then our central bank will have to kind of step in and ensure we don't fail, else we take the financial system with it. And one thing this kind of behavior does is traditional explanations for why money should be chasing a certain security and why it should be exiting a certain security. So correlations basically completely break down, and you're seeing enough evidence of that. And I think the more this accommodation continues, the longer this cycle of broken down correlations will continue. So is this a disruptive financial ecosystem that we are living in? Yes, it is. And are central bankers responsible for it? I absolutely think they are. Not to take away the merits of what they bring to the table, But I think for me to say, hey, you know what, I'm going to load up on this security because I know that the central bank, is behind me and it'll kind of shield me from any adverse reactions. This cannot last for long. So, and we've spoken about this previously, Abhishek. We don't know how long the party will continue.
Right.
But when it ends, it'll be a spectacle, just as 2008, 2009 was.